Hello everyone and welcome back. My name is Greg Furman and this is the Forex Weekly Outlook for the week of September the 19th, 2016. Now, to begin this week, we're going to begin where we always do with the US dollar index. Now, we have a very choppy week ahead of us with the Federal Reserve, the FOMC, their interest rate decision, followed by their press conference. It's going to be a very volatile week here, guys. So please try and keep that in mind and apply that as need be to your own trading. Now, when we look at to get started here with our dollar index, the first thing we want to observe here is we do have a fresh triple EMA cross from VantagePoint right above this 18-day predicted EMA, which comes in currently at 95.46. Now, what I've talked about over the last several weeks, or if not several months, is this Brexit range that the dollar still remains in, where we largely remain trapped inside this overall move. Now, the dollar made significant gains after the Brexit announcement, the other major event risk in 2016. But this current Fed meeting is absolutely a major event risk for all markets, commodities, equities, and of course currencies. So we are going to likely have a breakout after this. The dollar is likely the dollar is either going to break out or it's going to fall back and it's going to sell off considerably on a dovish Fed. But I don't think that's what's going to happen here, guys. Even though the Fed is probably not going to hike rates next week, they're likely going to signal the market they are getting ready to. So probably going to continue to support the US dollar. Now, we can also assess here on the key indicators from VantagePoint here that I want to point out. Our neural index, our predicted short, medium, and long-term differences are all pointing higher. Our predicted MACD is trying to break above the zero line, which is also something that will potentially signal a new trend. And of course, our predicted RSI coming in at 69, which is not actually overbought here at all, guys. It's showing momentum in the market. So once again, you know, there's a number of different examples across this chart that I can use to illustrate that. But basically, in my respectful opinion, for next week, our initial target on the dollar index is going to be back into this 96.75 area, and then we must break free and clear of these swing highs that are up in the 97.50 area. If the Fed is hawkish, then that will absolutely happen. But remember, guys, we cannot predict what the Fed is going to do. Now, this past week on the fundamental side with the data, the retail sales were a horrible number, but the CPI was a little bit hotter, and that basically led to a boost in the dollar, and everybody's hopes are up again that the Fed is going to hike. I don't believe they're going to, but they are going to signal. So obviously this is having a very negative effect on the equity market. So when we look at the equities, what I talked about last week was again this Brexit high, our breakout area, which was back here all the way back in July here. We've managed to stay above here, but you can see now that we're basically all tangled up around this swing high from the Brexit. Now, the VantagePoint triple EMA cross, which took place basically over a week ago, which I suggested in last week's video that the equities would have a hard time making any gains this past week, which they didn't. So the key VantagePoint level for the futures traders here for next week, 2150, the 18-day predicted EMA. As long as we hold below that level, guys, the equity markets are going to remain under potentially significant pressure. You can see on the global equity front, the DAX is doing the exact same thing, which basically helps to solidify the theory that the markets are globally connected, which in my respectful opinion, they absolutely are. We can see the DAX is selling off. The Nikkei, another major player here, guys, with the dollar-yen pair. And it's, you know, looking at those Asian equity markets, they're not doing well again. They've slipped through. We've been able to break above the 17,000 mark, but we're not able to hold above it. So, but we do have a new high here, but there's still sellers up here, guys. This is the problem we're dealing with here. So right now, the global markets are waiting on the FOMC announcement, and it is going to be a significant one. Now, When we look at our major commodities, not a big shocker here, guys, that oil is under pressure yet again. So I think that, we've had a bit of a retracement and now we're pushing lower. The supply remains high, demand remains low. We're going into a known seasonality of weakness in light sweet crude oil, and the equity markets are not helping the bullish case for the oil contract. So I think we still likely have further downside on oil despite its price at closing the week at 43.62. Right now, the market's been well contained under the 48 level. And I don't see any real buying probably until we get back into the major swing lows down around the $40 per barrel mark. And even that, I'm not convinced at this particular time that we're going to see a lot of buying. Now, gold is suffering the same fate as oil in the equity markets. When the dollar strengthens, we're seeing gold markets turning lower. We've got that fresh triple EMA cross. And once again, guys, even if the Fed doesn't hike, which I don't think they will, if they signal they are going to in December, then that is going to put significant downward pressure on the yellow metal here. So we want to keep this in mind here, guys. There's a lot of different websites out here, with conspiracy theories, gold 5,000, all of this nonsense. Just, guys, we need to focus on current price and the current market conditions. So gold's next move is going to be determined by the Fed, but right now, rightfully so, the VantagePoint has had a very strong sell on gold this past week. Our indicators are completely confirming this. Once again, here we see one of my favorite indicators here, the medium-term predicted difference crossing over the long-term predicted difference. That sent gold from 1340 down into the 1300 range, $40 an ounce down. Not a bad move here, guys. The predicted MACD confirmed that. The predicted RSI breaking below the 40 line. First we broke below 50, then we broke below 40. That signaled potentially a bigger move could be just underway again on the yellow metal. So long's not looking very good until at least Wednesday or Thursday, once we know what the Fed's game plan is. Now, as we go into our major currencies, the first one here, once again, guys, I want to point out here that we are trapped in this Brexit range. Nothing has changed at this particular time. We've got about the 114.50 and then down into the 109.20 area. So we're probably going to head into the 109.20 area if the Fed signals that they are going to hike in December. So we can see our RSI breaking below. We've got a crossover down on our predicted MACD. And then once again, we've got our medium-term predicted difference crossing over our long-term predicted difference, neural index down. Everything right now is pointing lower. But again, this trade shorting the euro is dependent on what rhetoric comes out of the Fed. We know that these people, they tend to talk out of both sides of their mouth, guys, so it's very difficult to predict what the Fed is going to say on Wednesday. So leading up to that, I don't think we're going to see a lot of buyers on the Euro-US pair, but I do think we are going to continue to see buyers on its counterpart, which of course is US Swiss franc. Basically the same trade here, guys. Euro-US down, US Swiss franc up, and vice versa. So when we look at that critical level on the US Swiss franc, 97.53, longs can be attempted off as long as we're holding above this key VantagePoint 18-day predicted EMA. We can see that our predicted differences in our strength indicator is warming up to the idea of a long. The neural index has been confirming the whole time. We're running basically flat along the zero line on the predicted MACD. That is not where I like it to be. We need this predicted MACD advancing forward here, and staying above the zero trigger. And again, 62, when I look at this 62.8 on the predicted RSI breaking higher, everything there telling me that the US Swiss franc has further upside potential. But what we really want to watch this coming week here, guys, is any big sudden moves out of the currency markets. Now, what I've noticed, and I've talked about here on Trader Planet many times, that a lot of these moves, by the time we get to Wednesday, it's a non-event because somebody leaked this information. So personally, I don't feel that the CPI data was hot enough to really cause a big rally on the dollar like what we saw on Friday, and I think it's going to give it back on Monday. But if the market believes that that's just the start of better data coming out of the US, then they will continue to buy dollars hard into the FOMC. US Swiss franc would definitely be a target pair. Now, with the Great Britain US, I've talked about this one also repeatedly over the last several months on how important this breakout bar from this Brexit is. And it comes in basically around this 133 area. We saw a couple of retracement areas right here, and then we saw it again at this level right around this 135. And each time it is aggressively sold off just under the 135 mark. The Bank of England, their rhetoric is very mixed as to what they're going to do, what their game plan is. They're going to be more easing. What are they going to do with the Brexit? Right now, guys, clearly there's further downside here on the British pound, but once again, it comes down to what is the Fed going to say here. Now, our predicted short, medium, and long-term differences and our strength indicator are all pointing lower. The predicted RSI is in agreement. The predicted MACD is getting dangerously close to breaking the zero line on the trigger, and that would signal a much bigger move. Now, we saw a move just like this on the Brexit when we broke below the zero line, and we had an aggressive sell-off from the 150 area all the way down to 135. I don't think we're going to see a 1,500 pip move this time, but we could see a significant move if we get a very dovish rhetoric continuing out of the Bank of England. Now, as we move into the dollar-yen pair for next week, once again, the dollar-yen is going to be, all eyes will be on this next week with the Bank of Japan and the Fed. But what I want to point out here is that we remain also trapped in this Brexit range. A lot of people will draw ranges in very different ways, but I always take it off a significant event risk. And then I look for a new high for the market, a new low for the market, or to break out of this particular range. So after this massive move up and down on the dollar yen 3 months later, here we are, guys, still inside this. We can see that we attempted to break that range right here, and we had another failure. Down we went again. So looking at this right now, what I will advise everyone here is that if the global equity markets sell off here, guys, the dollar yen is likely to follow. So if the Nikkei turns and reverses back higher, dollar yen will go higher. But money is either going into the yen or it's going into the Nikkei, 225, one or the other. Okay, so when I look at this right now, I'm saying that the key vantage point level comes in at 102.18. We're closing at 102.25. Still very, very sideways. In a perfect world, the dollar yen will trade sideways right up until the minute the FOMC releases their information. But as of late, that is not what has been happening. There has been a significant move in the dollar yen pair prior to any major event risk, meaning that this information has likely been leaked by somebody in the Federal Reserve. I have no evidence to support that. I'm just simply telling you what I see in the market, guys. And that's what we need to look for here, is we're looking at how is the market reacting. Do we have a lot of, when we have a lot of random buying or random selling a day or two prior to a major announcement, clearly somebody knows something that we don't. So be very, very cautious of this particular pair. A significant break of the VantagePoint 18-day predicted EMA at 102.18 will send us likely lower down into this 99 level. But if it's positive data from if the Fed's very hawkish, the dollar yen may get a boost and start moving back up towards the swing highs at the 107. But right now, the VantagePoint indicators are warning us that this pair is in serious trouble to the downside here. Our predicted difference is breaking below the zero line. We're hugging this zero line on the predicted MACD, but the RSI is not confirming this. So once again, guys, we've got a very mixed signal here. We do not have that triple EMA cross taking place just yet. We're very close at 102.27. But we're not there yet. We can see 102.18 for that triple EMA cross to take place. We have to have the 3-day crossing over the 8-day and the 18-day predicted moving average, which at this particular time we don't. So be very, very cautious with this pair next week. Now, as we come into the Canadian dollar, once again, we are attempting to break through that Brexit swing high that I've been talking about here. We've got up above it before for several days, but we have been unable to hold it. We tried again here just a couple of weeks ago. We had a failure, but then we basically had a new trend line had formed right here, and a strong triple EMA cross. Now, my concern with this particular triple EMA cross is that the further the 3-day gets away from the 8-day and the 18-day predicted moving average, the more likely the market is going going to retrace. This has absolutely nothing to do with Fibonacci or Elliott wave or any of this nonsense. What it has to do with here, guys, is we start to run out of buyers. And when we start to run out of buyers, the current buyers that are in the market are going to take profit and they're going to close their position, which basically sends the pair lower. There is a risk here. The VantagePoint 18-day predicted moving average coming in at 130.53. As long as we hold above this area, then longs are clearly favored with lower commodity prices, a stagnating Canadian economy, a new Liberal government that's in power that's struggling here. A lot of different things going on in Canada, but mainly we've got those oil prices continuing to move lower, which basically puts us in a sell position on the Canadian dollar or buying the US Canadian pair. So when I look at our key signals here, once again, guys, I want to point out this signal that I talked about last week, that how much I like this. The medium term crossing over the long term predicted difference. We've got our neural index. Everything looks good here. Our short term predicted difference right here is a bit of an issue for me, though. We can see that the short term trend getting a little bit softer to the downside, but as long as the medium term continues to advance and the long term predicted difference continues to advance, we should be fine. We've got our predicted MACD crossing above the zero line. The predicted RSI 75.1. We still have room to extend here, but we are starting to get a little bit tired. But once again, guys, the Fed can easily send this pair up into the 140 range. If we get a very, very hawkish Fed and we have a very dovish Bank of Canada, then that's going to trigger a significant long here back into that 144 area towards year end. So keep an eye out for your longs, but I suspect we are going to retrace back into this 30.53 area before we advance higher. Now, the same, I think, in this particular case, our other two commodity currencies, Aussie US and New Zealand US, not two of my favorite pairs here, guys, as any one of my clients would tell you. I find them to be very choppy, but there is some money to be made here, absolutely. So when we look at our critical levels here, right now, I've talked a lot about this Brexit high, the 76.50. As long as we're below this, shorts are carrying an edge. We're probably going to target back into the 73 area. Our key vantage point level is now coming in at 75.52. We have closed well below that at 74.86. So right now, shorts carry the edge. Why we hold below 75.52. So this level is a significant level, but so is the Brexit high. We have repeatedly tried to break above here, and we have failed every time, and we have slipped back inside this. Now, we can also see we're starting to see a series of lower highs here, guys. We're seeing a lot of this here. So once again, the Fed is going to dictate what happens to the commodities and, more importantly, the commodity currencies. So shorts carrying a slight edge for now, definitely, but watch the 75.52 area very closely. Now, our predicted short, medium, and long-term differences, our MACD, predicted RSI, everything looking pretty good here, guys, for it to continue lower. I would say that the same applies to New Zealand, but the New Zealand currency is much stronger than the Aussie or the CAD. It is the strongest of the commodity currencies. Now, in this past week, we have had a lot of buying and a lot of selling. So once we had this triple EMA cross that forced the market lower, you can see that we've hit this bottom down here 3 times, and each time it has moved higher. Now, what I will point out is that that's perfectly normal when we have a triple EMA cross like this. So the triple EMA cross has taken place, and the market is basically in a transition period, whether it's going to break down even further. 72.98 is the VantagePoint 18-day predicted moving average. We've closed at 72.59. If we continue to hold below 72.98 here, guys, then New Zealand is probably getting ready for a much bigger move. In my respectful opinion, if we lose the 72.40, 72.30 area, that alone could be enough to trigger a much more violent move down back into the 70 level. Now, just because the New Zealand currency is so low, people say, well, it has to go higher. No, guys, it doesn't have to go higher. It needs a reason to go higher. It needs higher gold prices, iron ore. It needs equity stabilizing. We don't have any of that right now. Particularly the commodity issue here is the one that stands out. Metals precious metals moving lower across the board does not support longs on New Zealand US at this particular time. But the Fed could change this and could easily send the New Zealand pair back up to 75 where it was just a few weeks ago. But again, I'll point out here, guys, that we are struggling to hold above that Brexit swing high bar from way back in June here. Okay, so we had multiple attempts to break it here. We failed. We come back up. We had multiple attempts all along here, and we failed again. But then we had a big push up here for just a couple of days on that strong New Zealand data, only for it to turn around and go right back down again. Okay, so right now, guys, this is the big level that same level that I talked about in last week's Forex Weekly Outlook, the 72.40 area. That's the big area that we're going to watch here. If this breaks, we are probably going to see gold lower across the board, equities lower across the board, and more or less a risk-off type scenario, along with, of course, a hawkish Fed. So there will definitely be no shortage of volatility this coming week, and I wish everybody the best.